Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
Well, good morning. I entitled this talk a little bit after my book, Magnetic Capital, and let me tell you a little bit about the genesis of this book. I started my career actually as a microprocessor designer. This is not the typical career path into the world of real estate investing. I started out designing microchips. I have chips in all kinds of different applications all over the world. If you've, for example, flown on any Airbus aircraft, the seat back display for all the movies and so on, that's my microprocessor. I'm in Cisco wireless access points, Panasonic printers, pachinko machines in Japan with Sammy Sega, all kinds of different applications all over the world. And in fact, if you've made a phone call in North America anytime after 1991, 52% of the phone calls were processed by a chip that I designed. So that's my background. And in that time in the tech industry, I got involved in a lot of business development and learned how to raise capital. Raised a couple of $100 million over the span of a couple of different transactions, did a lot of mergers and acquisitions work. And then in 2008, 2010, moved into the world of real estate investing and real estate development, and discovered that the process of raising money is exactly the same. I ran out of my own money, as everybody does in the world of real estate investing. Doesn't matter who you are, you're going to run out of money because it's a game of big numbers. And discovered that I basically needed to relearn that whole process, and after I did that, discovered the process was exactly the same. And that was kind of the genesis of the book Magnetic Capital. Now, the other thing that I discovered along the way is that when you are looking to put together a project, it doesn't matter whether you're an investor, or meaning a passive investor, or whether you are a deal sponsor, you're looking for that ideal fit. You're looking for that perfect fit, essentially like a pair of shoes. Imagine for a moment that you go to the shoe store and you see the most beautiful pair of shoes, and my God, it's your lucky day, they're on sale. But if they don't fit, you're not a buyer. It doesn't matter how beautiful they are or how deeply discounted they are. If they don't fit, you're not a buyer. And when it comes to raising capital or investing, you're also looking for that perfect frictionless fit. And if there's any part of it that feels forced, it doesn't work. And that's kind of the core of what we're going to talk about today. So put up your hand if you would consider yourself a passive investor. Okay. And put up your hand if you would consider yourself someone who is an active investor. And by that I mean if you're the guy who's going to be there standing in front of the zoning board for the zoning application. Put up your hand if that's you. Okay. So these are two sides of the same coin. Whether you're a passive investor or an active investor, you're still looking at the same criteria, but just from a different perspective, just from the opposite side. So I put a handout on the table here, and we're going to go through this as we get into the core of it. I've written, this one is from the perspective of a passive investor. If you're an active investor, I've got another version up here, and I'll hand that out to you so that you can look at it from the other side. Okay? So let's go. One of the things I discovered along the way is that if you want to accomplish anything in life, you need three things. It's not enough to have 1 out of 3 or 2 out of 3. You actually need all three. First is kind of obvious. You need the knowledge. So, you can go to a course, you can take a workshop, and you can acquire all the knowledge. And one of the mistakes a lot of people make is they say, you know what, I took the seminar, I've got the knowledge, I'm good. And it's not enough. It's simply not enough. The second thing you need is you need the emotional drive. And connected with that, you need to overcome whatever emotional obstacles are getting in the way for you to achieve that thing, whatever it may be. And the third, and this is the most important and the most overlooked, is you need to be in the right environment. It's not enough to have 1 out of 3 or 2 out of 3, you need all 3. So congratulations, you're actually in the right environment today. If you're sitting at home in front of your desk looking to Google for answers, it's not the same as being in a room like this. You know, when I go hang out at Starbucks, I'm the weirdo in the room. I'm like, there just aren't other people there like me, but I come to a room like this and I'm at home. To underscore that, this is my spin bike. It's at home. It's a great spin bike. It's a Schwinn. I love it. So the question is, why would I get up, it's still dark out, 5:30 in the morning and it's cold in the wintertime, jump in my car, drive 15 minutes to the gym, and go into a room full of 35 other spin bikes when I have one at home? It's not that I need the instructor to tell me how to operate it. I just get a better workout in that environment than I do at home by myself. And this really applies to pretty much everything. Okay? So, what do? I build and reposition apartment buildings. That's mostly what I do. So today, if all goes well this year, we'll build about 560 units of new construction. So we're fairly active in a couple of different markets. I started out in Arizona, then Chicago, then Philadelphia, and now Louisiana and Texas. So we're fairly active in a number of different markets. Just so you don't think I'm superhuman, my very first investment was this one-bedroom apartment in the downtown of Ottawa. I noticed, and I'm not a typical real estate guy. A lot of real estate people, they talk real estate lingo. I'm not a real estate guy. I'm a business person. And I look at just the fundamentals of business. Is there market demand? Things like that. It's funny how people get wrapped around the axle and talk about all kinds of things that make no sense, and they justify it with all kinds of jargon, but it's just very simple economics. So I started out in Ottawa long before the days of Airbnb and VRBO. I noticed that there was a demand. We're the nation's capital, so we had a bunch of folks coming into town, whether it was embassy staff, parliamentary staff, military officers, who needed a medium-term place to stay. The typical 12-month unfurnished lease was of no use to them, and a hotel was too expensive for their housing allowance. So I saw that market need and said, I'm going to deliver an executive suite product. I knew what the answer was. At the time, the housing allowance was $1,600 a month. So I said, okay, what can I deliver for $1,600 a month that is going to service that particular market? And that's how I got into real estate. I just saw a market need and filled it. And I approached it from a business perspective, not from a quote-unquote real estate perspective. And that's pretty much how I've applied the same thinking to virtually everything that I do. Today, this is a current project. It's a little bit of an eye chart. This is a site plan for a 240-unit new build in Lake Charles, Louisiana. This is a funny town. I'll just take a moment to describe a little bit about this. This is a town of 200,000 people along the Gulf Coast. There's a highway that runs all the way from Florida to Arizona called I-10, Interstate 10. And there's a ton of stuff along I-10, everything from Houston to Baton Rouge. And Lake Charles is halfway between Houston and Baton Rouge. And this little sleepy town of 200,000 people has $118 billion, that's with a B, of petrochemical and seaport expansions over the next decade. So that's a huge, huge number. There's just a massive influx of money, growth into this small town. So we're developing, they need everything. So we have 4 projects in this town. This is one of them. We're building a medical office complex. We're building a senior housing facility. We've got a workforce housing facility. So we've got a lot of stuff going on in this town. This is the kind of stuff that we get involved with. And again, I'm not taking a real estate perspective. I'm looking at it, okay, where's there a need and where can we add value and satisfy that need? We may build a self-storage facility down there because that's something that they definitely need. There's a bunch of things that they need. So what I discovered when I got into raising money, I made a lot of mistakes. The first time I went out to raise a couple of $100 million, I went about it all wrong. I really wasted a lot of time. And through trial and error, discovered that when it was easy, there were 5 things that were in place. And when all 5 of those things were satisfied, raising money is actually one of the easiest things to do. And when one or more of those are missing, it's incredibly, incredibly hard. So if you're an investor, back to the shoe analogy, you want to evaluate it from the same 5 criteria, but from the other side. Are these 5 things in place? And is there a fit for these 5 principles? So I'm going to go through these 5 principles because I believe if you are looking to raise money, it'll make you a better deal sponsor. And if you're looking to invest, I think it'll make you a better investor. Because then you'll be able to have a much clearer set of criteria for, is this the right fit for me? I'm not going to tell you specifically what's the right fit for you, but I'm going to give you the criteria so that you can determine what is right for you. Does that make sense? The 5 principles are relationship, trust, results, meaning your track record. Do you have a compelling opportunity? And is there alignment? I'll go through each one of these. So let's start with relationship. And I use the word relationship. It's very different than, say, networking. Networking is a very utilitarian term. You go to a networking event. You're kind of using people. You're there to get something as opposed to give something. When you're relationship building, it's about valuing the relationships first. And think about it. If you're dealing with someone with tremendous wealth, like nobody wants to be used. Like put up your hand if you want to be used. Like, nobody does, right? And in particular, if you have a lot of money, you're very sensitized to the fact that people want to develop a relationship with you for one reason only, because you have money. Well, you don't want to be used. You're a human being just like anybody else. So the filter is already up, with that individual. So it really has to start, the foundation has to be genuine relationship. It starts and ends with that. Most people don't invest with people they don't know. I mean, would you part with a few $100,000 of your hard-earned life savings with someone you had never met before? I sure wouldn't. So it really starts with relationship. And you want to look at the character of that relationship. How well do you know this person if you're looking to invest? How do they interact with you? Do they really value you as a human being? Do they value the relationship, or are they looking to you simply because they see you as a source of business potential? If they see you as dollar signs, I'd be cautious because you're getting set up to being used. Okay? The second principle is trust. And trust is a complex psychological contract. If you're on the sponsor side and you're looking to attract investment, the investor is going to be asking questions like, can I trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you to hire the right team? Can I trust you to communicate in an open and transparent way? Can I trust you with my money? Can I trust you to resolve a problem? And it goes on and on and on. And if any one of those are missing, it kind of doesn't work. It's a much deeper psychological contract. And also at the foundation of this, you have to have alignment of intention. If you don't have that alignment of intention, it's going to be very difficult to establish trust. Because if you're not headed in the same way, the same direction, that trust is not going to establish. Now, when the trust exists, decisions get made very, very quickly. If you as a sponsor hear from your investor, well, I don't know, we need another 2-3 weeks to complete our due diligence, there's a clue that maybe that trust hasn't been fully established. And you as a potential investor want to examine this very carefully. Every single successful entrepreneur I know, every single one, I don't know of any who has not been screwed by a partner. I don't know of any. And if you try and do it all yourself, you can't succeed. The only path to success is through partnership, unfortunately. They're complex. they're fraught with peril, and it's the only way. So the key is to establish good partnerships. That's really the only way. Next, track record. Show me that you know how to be successful. Show me that you have a track record of making money. And show me that if you have run into trouble, you had the wherewithal to make it right. That's what you're looking for in a track record. You know, rookies make mistakes. Everybody makes mistakes. Every single project is different. Every single project has situations that come up that you never could have foreseen. If we have time at the end, I can tell you some more stories that you just be sitting back in your seat going, how could you have ever predicted that? So things do come up. This is the real world. And you need people that are seasoned who know how to withstand that, how to have the fortitude to figure it out, how to marshal the resources, figure it out, and resolve the issue, because issues do come up. This is, like I said, the real world. Next, you need a compelling opportunity. The number of times I've heard somebody say, boy, I just had a great deal and I couldn't get it funded. Well, in my experience, that almost never happens. If it's really such a great deal, the money will find it. All good deals get done. They do. The only question is it going to get done by me or by you or the next guy? All good deals get done. And they usually get done fairly quickly. If something is taking a long time to get done, or maybe you're looking for money in the wrong place, or maybe you're not connecting the right way, but for the most part, all good deals get done, and they get done quickly. So what is a compelling opportunity? That's a little bit like asking, is the image on the front of the magazine cover beautiful? It's a little bit subjective. It's a little bit in the eye of the beholder. So if your thing is, my definition of beauty is, let's say, medical office buildings, well, then nothing else is going to appear beautiful to you. Someone shows you a mobile home park, not interested. If someone shows you a storage facility, not interested. Your definition of beauty is a medical office building at an 8% cap rate or better. That might be your definition. That might be compelling. So it's partly getting clear on exactly what that definition of beauty is for you. And for me, I only look at deals where there is a lot of margin. And what I mean by that is I'm looking for projects where the project at the project level has the ability to generate on an annualized basis 20 to 30% or better annualized net profit. Now you might be saying, wow, that sounds like a really high bar, and it is. But if I have a project that can generate 30% per year, and it takes a body blow because something happened, well, now my margin drops to 25 or maybe 20%. That's still okay. That's still very survivable. But if you're doing a project at, say, 10% net profit margin, you can have one thing go wrong and you're a break even. You have two things go wrong, now you're underwater. I like fat projects. I like fat projects because they're very resilient. They're resilient. I like projects that are relatively simple to execute. Now, not everything we're doing is simple. Sometimes we'll do things that are a little bit more difficult because they're maybe difficult for most people, but they're relatively easy for us because we have the expertise. It's like saying, well, I'd never attempt brain surgery, but for the brain surgeon, it's routine. So, you got to be dealing with the right people, but, it's got to be a project that's relatively straightforward to execute. It's got to be simple to understand. If there's too many moving parts, then the risk of you executing it successfully the chances of you executing it successfully go way down. I'll share with you one of our strategies that we've used very successfully many, many times. And by the way, when we talk about deals, I don't start here because most rookies start and make it all about the deal. And you know what? It's never about the deal. It's really never about the deal. It's about all those other things. This is really, because deals are everywhere. They really are. We have more projects that we could ever execute in a lifetime. We've more projects that would actually meet our criteria than we could ever go execute. Even in today's environment where people are paying stupid prices, I'll explain in a moment why that is, but but there's more opportunity than we could ever go fulfill. So one of the strategies that we use is what we call buy on the line, move the line. And every city in America has this line. In Nashville, it used to be East Nashville. Then Brittany Turner at Aerial Development Group came along, and she started building out East Nashville, and going into areas that, kicking out the drug dealers and getting rid of the war zone and turning that neighborhood into a decent neighborhood. There's probably other lines in Nashville that are like that. I'm not from here, so I don't know all of it very well, but this is a line in Philadelphia. To the east, you've got Temple University. To the south, you've got the downtown. To the west, you've got Brewerytown. If you go north 2 blocks too far, you're in the hood. Every town has this, right? So what we did is we started buying properties all along this line, just on the wrong side of the line. And if you redevelop that line, now the line's on the other side of your property. Now, if you do 1 or 2, it's not enough. Nobody cares, nobody notices. But if you do 5 or 10 or 20, the marketplace says, oh, I get it, the line has moved now. So you can buy property on the wrong side of the line for 10 cents on the dollar. But there's no comps for new product in the hood. So the only comps for new product are on the good side, on the other side of the line. So you're going a couple of blocks away. Now, that line has to be a movable line. If it's a municipal boundary, or if there's a freeway in the way or something like that, that's going to be much more difficult. But if the line is arbitrary and is movable, move it. And now you're going to get 95 to 100 cents on the dollar in terms of comparable value for that new product on the wrong side of the line. Now, don't go too far, because you're going to get stuck in the hood. But if you stay close to that line, and sometimes the line is not a perfect line, sometimes it's a little bit more like Swiss cheese, but you want to basically redevelop that line. I'll give you an example of a project we did. I can give you a dozen examples. It doesn't matter. This is just a small one. This is 1228 West College Street in Philadelphia. It was 3 beautiful townhouses. As you can, I can't capture the smell quite on the photograph, but that's what we redeveloped. And this is what we designed to replace it. This is an 11-unit apartment building. And one of the problems in Philadelphia is that there's no parking. And it's an older city, one of the oldest cities in America, built long before there were cars, so there's really no parking. I know people that will not take their car. They will take an Uber because it'll take them too long to repark their car. That's how bad it is. So if you can deliver a product that incorporates parking, that is a huge differentiator. So we elevated the building up onto 2nd, 3rd, and 4th floor, and we did ground level structured parking underneath the building. Again, not taking a real estate view, taking a market view. What does the market want? So if there was ever to be vacancy anywhere in the city, we'll get the vacancy last, because everyone always wants parking. It's just in such demand, will always be full. We know that. In order to maximize the number of bedrooms, as you know, bedrooms need to be at the perimeter of the building. We're building the building right to the lot line, so you can't put windows on the lot line, because there could be a building right next door to you, theoretically. So we designed a building with an inner courtyard, and we put the windows on for the bedrooms facing the courtyard or facing the street. So we were able to maximize the perimeter of the building by designing it that way. And we had the courtyard facing south, so you could get beautiful views of the downtown skyline from any of the windows. We did a bunch of value engineering, and this is really designed to minimize the cost. So for example, we did things like, so I'll show you, go back to here. The architect designed all these beautiful archways with these like hyperbolic arches, and they're crazy expensive to build. Just incredibly expensive. So architects will design things for you that are beautiful, but maybe not cost effective. So we had to go back and value engineer this building. We had the drainage so that it was coming into the center of the building. We had pipes going down through the center of the building. We said, no, we're not going to do that. We're going to put a little bit of a slope to the roof, drain it off the back, and get rid of a bunch of costs that way. A bunch of little things like that save a ton of money. You'll notice we reduced some of the window sizes. You'll notice that there's no boxing overhead in the framing We use the European style HVAC, the air conditioners and heating. So these are wall-mounted units. They're actually more expensive, but because there's no ducting, it's actually net cheaper, and you have individual temperature control in each room. Now, not everybody likes that because there's a little bit of fan noise in every room, but it gives everybody individual control in each room, and it's cheaper to build. So these are all different types of trade-offs, the types of things you get into when you get into developing. And you'll notice there was no flashing red light on this property saying, I'm a deal, come get me. So we weren't out there hunting for deals. We created this. We created it out of nothing. So that's why I say there's more opportunity than we can ever fulfill, because we don't go find deals, we make them. And it's a creative process. So that's the finished building. We are now, that's an older picture from, I think, January. We're now, I think we are leased up 10 out of the 11 units at above our initial projected rents. So we're in good shape. A little bit on the numbers. We built this with $1.5 million in debt. The total project was about $1.9 million. And we have a valuation in hand for $2.6 million. So as soon as that last unit rents up, we're going to go back to the bank, refinance at 70 or 75% loan to value, recover 100% of our investment, return the capital, the equity side, return that to the investors. And we're now holding a property that's generating decent cash flow with a reasonable debt to equity ratio and zero cash tied up in it. It's the proverbial no money down deal. That's our formula. That's what we do. Is that compelling? I think so. I think so. Now, it's a little bit more work. We got to be, this took us 18 months to put together. But in 18 months, we generated, what's that, $700,000 in equity out of thin air by being a little bit patient. That's okay. I'm willing to be patient. These are what the interiors look like. So, it's a decent quality product. This is a B+ type of new product. These are the views of the downtown skyline. And that's our cash out, basically, on the property. So that's an example of what I mean when we talk about compelling opportunity, okay? And we can talk whether it's a small project, whether it's a big project. Today, most of our projects are quite a bit bigger than this. I think this year in Philadelphia, we're probably only going to build about 30 units, not very much compared to what we've done in the past. And most of our projects are much, much larger than this. But again, it's the same kind of thinking, okay? The very last item, the last of the 5 principles, is alignment. Now, you'll notice on the scorecard that I've given you a grading mechanism where you can assign points, and the way I suggest you use this is evaluate a particular project or a particular relationship that you're thinking of getting into, and you can essentially grade it according to a point scheme. The point scheme does not apply to the very last principle, and that's the principle of alignment. It's a pass-fail. You have to hit on all of these. If you don't hit on all of these, it's not going to work. You're trying to do something that's forced. I'll give you an example. Let's say you're dealing with a family office, and they've got $100 million liquid, and you're looking to raise $50,000. It's not going to work. It's not even worth their time to do the paperwork. For them, they probably have a $5 million minimum investment. So one of the things you want to look at is is there a match between the goals for the project and the goals for the investor in terms of the size of the investment? That's frequently one of the ones where you get a mismatch. Just because somebody has money, just because you have money, just because somebody needs money, doesn't mean there's a fit. You've got to be, again, looking for that perfect fit. So as an investor, you want to get very clear on what is your criteria for yourself. Now, unsophisticated investors, and I can tell an unsophisticated investor when I talk to them, because I ask them, what are your objectives for your money? And they say something very vague, like, well, make money, don't lose money, and that's about it. And when you go deeper and ask questions, well, like how large an investment or how small an investment are you willing to do in one investment, they don't have a clear answer. And when you say, how long are you willing to have your money tied up for? What's the term of the investment? They're not clear. Whereas a sophisticated investor, professional investor, is very clear on all of the criteria. What's the size of the investment? How long are they willing to have their money tied up for? How liquid should the investment be? What is the rate of return that they're targeting, both in terms of cash on cash and internal rate of return? What is the tax consequence? What is the risk associated with the project? And I'm going to separate risk and security because together those two combine to define what's called safety. So risk is what's the chances of something going bad. I'll give you an example. Let's say you're a lender and you're lending a 10% loan to value and you have a lien you're in first lien position. 10% loan, 90% equity. I don't care if that project goes bad ever because I'm always going to get my money back. So the risk is almost immaterial because I've got the security. Together, those define the safety of the investment. Flip it around, and let's say you're at 90% loan to value, you've got 10% equity. Now you're going to pay a lot closer attention to what's the risk because if it goes bad, you may not get all your money back. So those two need to be examined together. And then finally, what's the control structure? If there is a problem in the project, how is it going to get rescued? Can you go in and rescue the project, run ahead of the bank, solve the problem before the creditors come after you? Those types of things are also important to look at. How are you going to rescue a project if you need to? So how do you get good at this or anything? Well, number one, practice. You got to get in the right community. Don't do this by yourself because if you're sitting in a dark room just thinking things through on your own, you're going to be doing it from a very narrow perspective. And I encourage you to get opinions. You know, from, for example, folks in the room here that get a diversity of opinion. Don't ever go into a project on your own. Get into a mastermind, you know, get other experts to look at a project with you. Make sure that you're looking at it the right way. Attend conferences, attend syndication events where there's other investors. Maybe get a top-notch coach if that's what you need. Maybe get a mentor. There are other clubs. I mean, there's this club. You know, there's for example, the real estate guys. I know both Robert Helms and Russell Gray have been here. They have the Syndication Mentoring Club. It's a great place to go. You know, relationship build with other investors and gain access to other faculty members who will help you with that. I'm actually part of the faculty for the real estate guys as well. So that, you know, you want to get, again, into that right environment, and you're in a great start here in this room today. Here's how you can learn a little bit more. I have a few copies of my book. I only brought 6 copies, so I'm happy. They're only $20. Please buy them. I need the money. And you know, I'm actually very fortunate. I run a monthly mastermind with a gentleman named George Ross. And George is an extraordinary guy. He was Mr. Trump's attorney and right-hand man for most of the last 40 years. Now, whatever you may think of Mr. Trump is irrelevant. Whether you agree, disagree, like him, dislike him is irrelevant. He's a guy who has managed to amass a fair bit of wealth, and the guy that I credit for most of that is Mr. George Ross. And I'm just very blessed to have access to him. We have a mastermind call every month. I've talked with him twice a month for the last 7 years. Don't ask me how I developed a relationship with this extraordinary man. He's 91 years of age. I know a few of you in the room have met him. He's pretty special. And I'm just blessed that he endorsed the book. So that's kind of cool. You've got a copy here of the Magnetism Scorecard. Use it. I think it'll help make you a better investor. It'll help you gain clarity in terms of evaluating any particular opportunity. And Seth mentioned the podcast. So I run the Real Estate Espresso podcast. This is a daily show, 7 days a week. And you might be thinking, oh man, not another podcast. On average, people listen to 6 podcasts. How many? Put up your hand. How many podcasts? Just shout it out. How many podcasts do you subscribe to? 4, 3, 4, 10? Okay. The average is 6. And let's face it, the airwaves are saturated with podcasts. And I didn't want to do another hour-long show. That's the last thing the industry needs is another half-hour or hour-long show. So these are 5 minutes. And they're short, they're punchy. It's literally your daily shot of real estate espresso. Like it's your morning shot. And that's been resonating with people. So it's not competing with the other shows at all. And the feedback that I'm getting from listeners is consistent with that. It's filling a need in the marketplace. So check it out. Like I said, they're only 5 minutes. During the week, it's just me. Weekend edition is interview style with notable people from the world of real estate investing. And so got some pretty cool guests. I've got Robert Kiyosaki coming up next Saturday, which will be kind of cool. So we have, it's a great show. So that's it. Let me open it up to questions.
We'll do some Q&A. Let's thank Victor Menasce for being here with us today. I'm going to be up here with you, and Bill's going to be running the mic around. So sure. I'm just going to start with a few questions that kind of came up from my end as you were talking, and then we'll definitely open it up to the group. So
sure.
Talked about how some people are willing to accept maybe a lower cap rate or a lower return on their investment. There's a lot of reasons why that might be, but can you talk about why we are at that place as a market, just as a whole, not Nashville, but just the real estate macro market in general?
I've got a couple answers to that. And this is a kind of a personal perspective. Well, put up your hand if you believe that the safest place for your money is the stock market. Okay. You're alone. My perspective is that it's not. And yet that's what we've all been led to believe. And my reason for believing that is actually deeply personal. My uncle owned a seat on the New York Stock Exchange. He was one of the 1,000 members of the exchange. I grew up owning shares before, I even had a bunch of money in my own savings account. And so I learned an awful lot about the market from him. And then when I became an officer of a U.S. public company and listened to our CEO go on the Financial News Network and MSNBC at the time, and Jim Cramer's show, and basically lie to the investment community, I was going, damn, how many other boardrooms in America is that happening? Is this the only one? You, as the individual small investor, have no control. You really have no control. So in an environment where interest rates are very low, people are chasing yield. They're dumping money into the stock market. They're dumping money into Bitcoin, which makes no sense at all. It's not even an asset. They're chasing yield. And so they're simply trying to find anything that will, because there's too much money. There's literally too much money out there. That's really the number one reason. I mean, every time I see a large multifamily project appear on the MLS, there's going to be like 20 offers on it. I've experienced that. I was offer number 17. I'd never want to be the winning bid with 20 other players because I'm guaranteed to pay too much. So, yes, that is the environment today. Don't lower your standards. Don't cave just because everybody else is doing it. It is a little bit overheated. I call it auction fever. Have you ever gone to an auction and at the end of the evening you walked home and you say, I think I paid a little too much for that? That's called auction fever. And we have a little bit of auction fever going on.
Yeah, that's good. So new construction as a great alternative to some of the existing, B-class or C-class apartments that are out there can be a great alternative. And you touched briefly on why it might be okay to take maybe a 5% cap rate on a class or a B class as opposed to maybe a C or a D class. Can you talk about why that is?
I'm not a huge fan of anything that starts with a 5 in any class. So, for example, that 240 unit new build that we're talking about, we just got our as-built appraisal back. We're in the process of going through the HUD meat grinder process of securing a HUD loan, and that A-class apartment complex where we'll be getting an average of about $1,500 a month in rent, is at a 6.5% cap rate. So when I see C-class apartments, selling for 6.5, 6.7, I go, man, you guys are nuts. It makes no sense. So, like I said, I like projects with a lot of fat margin. That 11-unit building that I showed you, we built that for the equivalent of a 9% cap rate. It refinanced at a 6.5. So we got an appraisal for 6.5, but we built it for 9. So, and why is that? Because I'm getting valuations the equivalent of, let's say, $220, $230 a square foot. Well, my cost of construction was $112 a square foot. So if I can buy the land cheap enough and keep my soft costs under control, I can build in some profit. If I'm paying too much for the land, look, drywall costs the same. It's $10 a sheet no matter where you put it. Doesn't matter whether you put it on the most expensive street in town or if you put it in the hood. A sheet of drywall is $10. But it's going to be valued differently depending on where you put it. Right?
Yeah. So that's good. And with building new construction and working with higher class products like the ones that you're working in, you can secure much better financing than you maybe would for, say, a C-class apartment complex. Can you explain maybe why that is?
I'll answer a little bit differently. Let's talk about the difference between A-class and C-class, and I'll contrast those two, but there's, of course, B-class in the middle. I've never lost money on an A or B-class apartment. I have lost money on C-class, and the reason for that is because there's a lot more variability on the expense side, and it's much more difficult to predict. If you're only getting $600 a month in rent and an air conditioner fails, it's going to cost you $3,500 to replace that air conditioner. How many months of rent do you have to soak up to buy that new air conditioner? If you didn't factor that air conditioner failing into your pro forma, now you're deep underwater. And the air conditioner doesn't care. It's going to do what it's going to do. Whereas if I'm getting $1,800 a month and the air conditioner fails, that's a whole different matter. I can withstand that. So you've got a lot more variability in C-class. Now, no one's building C-class because the economics don't work. Because even at today's cost of construction, prices have gone up quite a bit. Today, we're bidding things out at around $120 to $124 a square foot in most parts of the country. Most part of that softwood lumber tariffs, labor's gone up. Those are the two principal drivers right now. So, I like A and B class. I think when the market turns, the demand for A class is going to fall a little bit. I really prefer mostly to be in B class, B plus. I'm willing to look at C class apartments that are a good value add, but boy, you can't pay too much for them.
So can you talk about maybe some of the markets? You obviously mentioned Philadelphia,
Yep.
Louisiana being another one. Yep. How did you arrive on those being the places that you want to invest? Because it's obviously not in Ottawa right. where you're from. And like Robert Helm says, you live where you want to live and invest where the numbers make sense. How did you arrive on those being the places where the numbers made sense for you?
There's a number of towns where the numbers make sense. And I never make it about the deal. There's a lot of places in the country where the economic conditions are right. There's a lot of places where the economic conditions are wrong. So number one, I will never go into a shrinking city. I will not invest in Detroit. I don't care how cheap it is. The population peaked at 1.5 million. Today the population's about 700,000. They lost half their population. There's a reason you can buy a 3-bedroom home for $15,000 and put it on your Visa card. Yes, it's cheap, and yes, you can get $800 a month for it, but when it's continuing to shrink, there's a reason. Supply and demand, simple fundamentals of economics, supply and demand. I want growth of population. I want growth of jobs. Because at the end of the day, the tenants, this is a mistake a lot of people make, they forget the tenants have the money. And you get money because the tenants transfer their money to you. If the tenants don't have the money, they can't transfer it to you. It's very, very simple. So you've got to go into an environment where the tenants have money. So that 240-unit new build that I showed you, take a guess what the average household income is for those tenants. Any numbers? 50? Any other guesses? 45? $90,000. $90,000. That's not your typical tenant profile. So I'm not going to spend a ton of time in collections. I'm not going to spend a ton of time, dealing with back rent and stuff like that. These folks make good money. They're skilled laborers, pipe fitters, welders, project managers. They're not moving to Lake Charles to make a career or a lifetime. That's why they're renting. But they want to stay in a nice place. They've got a good job. They're there for 2-3 years at a time maybe. They're on an assignment, working on a new plant or something. So that's the play.
So when you're looking at evaluating a new market, in terms of the nuts and bolts, can you walk us through maybe your process of how do you actually go about finding that data? Are there sources that you trust more than others? Do you physically go to the environment and sit down with people in a coffee shop? I mean, what is your process for evaluating the market?
It is really based on understanding at a very, I'll say, boots on the ground level. And I don't know how to make this repeatable for you, but I'll tell you how we got into Lake Charles. So one of my partners, her name is Sharon Foreman. Her neighbor, his name is Larry Race. Larry's brother, Bill, is the port director for Lake Charles. So we have direct information about what's happening in the port of Lake Charles, the 12th largest seaport in the country, soon to be number 6 or number 7. So when you get that information firsthand, you're not sitting at your desk looking to Google for answers. You're getting the real information from people that are in positions of decision making. Joe Jager built an 1,100-room Golden Nugget hotel and casino on port lands. The port is authorized by the state, so he can because he is the port director, he gets to authorize what gets built on that land. There's no zoning approvals, there's none of that. There's no community opposition, it's being built on port land as a ground lease. So you're dealing with the decision maker, face to face. You don't have to go through the whole political process and community opposition, all this other stuff. How do you repeat that? I don't know. You just got to find out the information. And it's part of being in the right environment. When you get into the right circles, that's where you get to see opportunities. I learned this from George Ross. Again, I don't care what you think about Mr. Trump. It's irrelevant. George has a personal net worth of $300 million. And he's an attorney. He didn't make that. I don't care what his hourly rate was. There aren't enough hours in a lifetime to amass that kind of wealth. He did that on the side. That was his side hustle. Okay? And he did that because he was simply immersed in an environment that spilled so much opportunity, he couldn't help but make money. And he came across those opportunities, again, exactly how I described, face-to-face with people. So just get in the right environment.
Yeah. And that's great advice. And that's honestly a big reason of why we do Music and Money. It's obviously to get to hear from great speakers such as Victor and Robert Helms and Russ Gray, but we really want you guys to be taking advantage of who's sitting at the table next to you, who's sitting at the table, somebody who you haven't met when you walked in this morning. The relationship really is the value, and that's the reason why people of Victor's caliber and Tom's caliber and Peter Schiff's caliber and Dave's caliber keep coming back to the Real Estate Guys event, because it attracts such a high caliber of people, and high caliber people like to be around other A players. So that's why we do what we do. That's why we do this group. That's why we set this whole thing up once a month. So take advantage of that. I definitely want you to get the content. For those of you guys who are watching online, get the content, but take it a step further and actually come physically be here, because those relationships, for me personally, have turned into real results. And that's basically what you're saying is those face-to-face relationships. So my last question, then I do want to open it up to crowd questions, and if you're watching on Facebook Live, feel free to write in your questions there, and we'll do our best to answer. Are there new markets that you're looking to get into as we speak, or new asset classes even?
I've been looking to get into Houston for a long time. And since Hurricane Harvey, the Houston market has become even more attractive, actually. Houston, for a little while, got a little bit overbuilt. Vacancy rates had increased to, at the peak, about 10-15% at the bottom of the oil market. Today, vacancy rates are running at about 3%. And there are certain parts of the city that, in retrospect, probably shouldn't have been built. And there is a clear differentiation between properties that are on high ground and ones that aren't. So Houston, to me, is a very interesting market. It's continuing to attract population. It's adding about 60,000 population a year net. On a percentage basis, that's not as much as Nashville. And Nashville is adding 100 people a day on average on a much smaller population base. So, I mean, Nashville's a crazy hot market. But Houston is very interesting to me, for sure. And actually, parts of North Dallas. There's a lot of corporate headquarters that are moving there, in places like Plano, Frisco, Allen. There's a lot of opportunity there. In fact, I talked about one on the podcast last week. One of my favorite asset classes is student housing, and there are a few universities there that are attracting a lot of growth in population. Now, nationwide, universities are not growing right now; they're actually shrinking. But there are select opportunities. So, for example, there's a college up there called Collin County Community College, or I think they renamed it Collin County College. 50,000 students, 0 student housing. 0. It's crazy. And how do we know this? Well, someone who I know, their daughter went there and couldn't find housing. Again, you're not going to find this out on Google. So then you look into it and say, you know what? This is nuts. There's land, developable land, within a short distance of the campus. We could buy that land for $4 or $5 a square foot. The numbers work. This is crazy. How come nobody's doing it? Sometimes it just happens. If there was a $1,000 bill sitting on the sidewalk, how many people would walk past it and not believe it's really there? Sometimes you just need to bend down and pick it up.
Yeah, so good. I love what you said earlier, and I wrote this down. Probably be a good thing for everybody to write down. But he said, we don't find deals, we make them. Yeah. We make deals. So being in a market like Nashville, that was really encouraging and inspiring for me to hear, because I think myself, along with probably a lot of the other people even in this room, have been sort of sitting on the sidelines saying, well, there's no deals. Right. There's no deals. You're out there actively making them.
Right. Well, actually, so put up your hand if you know or know of or have met Brittany Turner. Okay, so she's a great lady. So she started out at 21 or 22 years of age here in Nashville flipping houses. She worked for my buddy Paul Kazanovsky, who's a volume flipper here. He does 40 to 50 flips a year. She worked for him for a little under a year, and after that, she said, you know what? I've learned this business. I can do it better on my own. So the first year she went out, she did, I think, 9 flips, then 15, then 25, then 40, then 60. And by the time she was doing 60, she was doing predominantly new construction. She would go into communities here in Nashville where there are decent-sized lots, 50, 60-foot frontage, where these post-war single-story bungalows. I call them Eisenhower houses. I don't know if that's the right term, but she would basically tear that down and put up 2 narrow single-family homes on the same property. Modern design, with a roof deck at the back and a big glass garage door off the master bedroom, all kinds of funky stuff, and selling like hotcakes. Last year, I think she did about $30 million in new construction. I think she was Nashville's Businesswoman of the Year. Again, you go look at one of those little Eisenhower houses, I don't care what the price was, there's no flashing red light on it saying I'm a deal. It isn't. Because if you're only looking at it in terms of what is there now, it's not a deal. But if you look at it in terms of what it could be its highest and best use of that piece of dirt, then you can create it.
Can you talk about, and this will be my last question, because I know all of you guys, you just keep sparking all these new questions in my head, and hopefully this is helpful. But when you're going into, obviously, if you're putting up, 2 side-by-side townhomes, like you mentioned, like the Brittany Turner model, that's going to be a quicker turnaround time than, say, maybe a 100-unit new apartment build. What are your turnaround times from, okay, here's the idea, and then here's closing?
The biggest variability on any project, believe it or not, when it comes to new construction is getting the entitlements up front. And it's the upfront phase, it's not the construction. Construction takes about the same time, doesn't matter whether you're building a couple of townhouses or you're building a couple of hundred units. That construction timeline is almost the same. You're going to bring a whole lot more resources, but construction takes about the same amount of time. So if you're in a community where it's going to take you a year, 18 months to get the entitlements, well, you got to add that to the process. We just completed getting zoning on 3 different projects in Lake Charles, and we did that in 30 days. 30 days. I mean, think about that. I tell it to some of my developer friends here in Nashville, and they start crying. Like, it makes a big difference. We've, on the other hand, had situations in Philadelphia where it has taken us a long time. We had a situation where the city was putting in a claim of eminent domain over a large area, and some of our properties that we owned 72 properties, and some of our properties were on the list to be condemned. So we didn't feel comfortable building until that condemnation process went through, and as you can imagine, that wasn't fast. So, sometimes delays come up because of things like that, and usually it's at the front end.
That's great. All right, we're going to open up for questions because every time you say something, I think of like 3 more, and I'm sure I'm taking the time. So we'll go ahead and pass the mic around to ask some audience questions.
Thank you, Victor. So what do you attribute the difference in Lake Charles being 30 days versus some of the longer turnaround times that you had in other markets?
I think it's a smaller town, a simpler planning process. So in that particular community, we have to submit the plans the same as we would for any major city. It's exactly the same process, 4 weeks in advance, 15 copies. It goes out to all the city council members. Then there's a zoning meeting. 100 people show up in opposition with all kinds of different reasons why a project shouldn't be built. And then the zoning board votes, and then it goes to city council. If there is an appeal from any city council member, it'll go to city council for a vote. In the last two that we did, we had a 5-0 vote in favor of our projects, and it did not even go to city council, so it got approved that night. It's amazing. It just depends on the process. Other communities, they will tell you, you can submit your paperwork, and after 120 days, we'll come back with questions, and after 7 months, you may get an approval. It just depends on the community.
Hey, thank you again. I love everything you're saying, and the tone of voice you're saying it in. Okay. It's very comforting. No, it is. Most speakers try to be overly passionate, and you're just being truthful, and I appreciate that. But yeah, I was curious, industry-wide, is real estate now your thing through and through? Because I know you said first you're a businessman,
yeah,
and you look for real estate in the eyes of how can this provide to the public what they need most, highest and best use, right? And so I go, are you now just sold on real estate entirely, or do you still have your eyes open and willing to hear other, anything else business-wise? And
that's a great question. I do look at other opportunities, but for the most part, I don't want to be all over the place. So I really specialize primarily multifamily. We are doing, like I said, a medical office. We're doing a senior housing. They're all kind of similar. I've been approached. I get approached daily on all kinds of different things. To do things in agriculture, to do things in clean energy, various other opportunities, and I will evaluate them. You may want to write this down. These are 3 questions, because you will get approached too. If you have money, you'll get approached too with opportunities. And the first question I ask is, what problem are you solving? And oftentimes what I get back is where they'll answer me, well, my technology is really great. Yeah, but what problem are you solving? Oh, but it does this and that and this other thing. Yeah, but what problem are you solving? So if you don't have a crisp answer to that first question, the rest is irrelevant. So then the next question is, are they willing to pay money to solve that problem? Or are they willing to live with it? Is it enough of an irritant? Is it a source of acute pain, or is it just chronic pain? If it's acute pain, people will actually take action and spend money to solve it. If it's chronic pain, they'll probably live with it. So I'm looking for acute pain. I would rather sell pain medication than vitamins. Nothing wrong with vitamins. But if I don't take vitamins today, okay, no big deal. But if I'm in pain, I want pain medication right now, damn it. Right? That's the difference. And then the third question is, are they willing to buy it from you? And if you don't get a solid answer to all three of those questions, there's no opportunity. It's so simple. It is so simple. And people often just get wrapped around the whatever their technical thing is. And I'm a technology guy. I mean, I got deep in the weeds. I can tell you the spin on the electrons inside a microprocessor. I can go very deep. But it's not relevant at a business level. You really have to abstract back to the very, very simple.
Before you ask your question, if you wouldn't mind telling us your first name, where you're from. You guys know us. We don't all know you.
My name is Michael. I'm from Nashville, from Franklin. Given what you just said there, does that mean that you're not building parking buildings in Philadelphia because 2 and 3 fail?
That's a good question. Probably the number one reason we haven't built parking is we haven't really, well, the number one issue is zoning. Because the city is not, seem to be addressing that issue. You know, here's how you want to think about government. Government's telling you what they want you to do. So when they say this particular area is R1, they're not trying to tie your hands. They're just telling you they want residential in that area. That's all they're doing. They're giving you guidance. If the municipal plan overlay says this is a major commercial street, even though it might be zoned mixed use, you know, we're willing to accept, you know, 30,000 square foot, you know, commercial. They're giving you guidance what they want in that area. So if you're trying to go against the grain for what city council's looking for, it's an uphill battle. Now, not to say it can't be done. There's many examples of people who build very successful projects that way. We've created a tremendous amount of value getting properties rezoned. And it's a tough fight sometimes, and you can create great value. Lately, I'll say we've gotten lazy, and we just build stuff by right because it's easier and it's more predictable. So not right or wrong, it's just a choice that we made.
My name is Chris from Franklin here, and thanks again for talking to our group. Ironically, I drove through Lake Charles yesterday. And it's,
very cool.
Yes, definitely, and I think that...
what time of day were you going through there?
I was going through there at about 10 in the morning, okay. and also with the Supreme Court reversal on states being able to have sports betting. I think that's going to there are a lot of casinos, a lot of infrastructure already in Louisiana that I think that's even going to be a growing tourist area. But that's not my question, though. But I thought that port is rather large and the bridge is pretty cool to drive over.
So just to interrupt you for 1 second. So that bridge experiences an hour and a half to 2 hour traffic jam every day on Interstate 10 twice a day. So if you work where most of the plants are on the west side and you reside on the east side, you're spending 2.5 to 3 hours stuck in traffic every day. Think about that. So when you're building, where you build makes a difference. And here's the town. Again, it's a sleepy little town, 200,000 people, and it's got hour-long traffic jams. Who would have known?
Yes, luckily we didn't hit that. But speaking about zoning and getting things, putting deals together, my question is do you have to make a case of a positive economic impact on a local area to the zoning boards? Is it mandated by them? And obviously, how do you go about that process of saying, okay, this is going to create X amount of revenue locally, and it has to have a positive economic impact to get approved? And thank you.
It's a great question. Most land has some kind of zoning on it, and none of those are zoned vacant. Okay, unless it's zoned rural, which is kind of, but if you're within the city boundary, nothing is zoned vacant. So you're going to put something on there. So question is, what is the zoning? Now, if you're below a certain size, you're doing what's called a minor application versus a major application. If it's a major application, all that means is you've got to consult more people. But if you're still building it within the zoning, meaning you're not changing the zoning, you're building by right, then you don't really have to make a case. You just have to follow the rules. So for the rules will say, for example, for every 300 square feet of office space, you have to have one parking space. So you do the math and you say, okay, I need so many parking spaces. You just follow the rules. They say you have to have a 15-foot side yard setback and a 25-foot front yard setback or whatever. You just follow the rules. And you don't actually have to justify the project to the city. That's kind of your thing.
Hey, Victor, I'm Billy from Nashville. My question goes back to the attraction of capital. Ironically, we're in a situation where we see deals all the time, so deal flow is not a problem for us. For us, is actually attracting that capital. So my question for you is, how long did it take you to hone in on what was right for you? And did that morph from the beginning, or kind of walk me through that process from the beginning to now where you're at and, what you did to hone that in?
That's a very good question. Go back to the 5 principles. So principle number 1, relationship. As you look to scale up, for me as a sponsor, looking to scale up and attract more capital, if relationship is key, then I become the bottleneck in terms of how many relationships can I build and how quickly can I do that. And relationship building is one of those things that takes time. You can't start a relationship if you need the money by Friday. It's just not going to work. And it's just like these are human relationships. It's just like a romantic relationship. If you skip steps in that process, you go from a natural progression of a relationship to creepy in a heartbeat, right? I mean, you appear desperate, and desperation is never attractive, right, ladies? I mean, it's just not attractive. So it's the same in business. It's exactly the same. So I'm constrained in terms of the number of relationships I can develop. So the only way for me to scale up is to bring in other people with their relationships and put together pools of syndicators. So maybe to get other people to sub-syndicate. The last several projects we put together, we got them funded in a couple of hours. So it's because we had the right people working with us. That makes a difference. If I have a sub-syndicator that has a dozen relationships and I don't have any of those relationships, but that sub-syndicator is aggregating that money and writing a check for $700,000, $900,000, that saves me a lot of time. But you got to be working with quality people. That's I don't know if that's the only way, but that's how I found to be successful. Early on, so the question was, how did it morph from early on when we were just starting out versus today? The projects were quite a bit smaller, so we were looking for very smaller, much smaller sums of money. That 11-unit building we only needed, I think, about $400,000 in equity. That was one investor. That wasn't difficult. But what I found is projects, from my standpoint, as a developer, projects take the same amount of effort, regardless whether it's 1 unit, 2 units, 10 units, or 200. The work that I have to put in is virtually the same. So all other things being equal, do I do a duplex or do I do a 200? I'll pick the 200, thank you. Right.
Hey, Victor, thanks again for all your insight. I had a quick question about how you went from that little condo or apartment in Ottawa to what was the biggest thing that you did after something like that, and how did you make that transition?
Great question. I wish I could tell you that it was a perfectly straight line and I didn't waste any time and I didn't make any mistakes, because none of that would be true. So from there, I went into rent to own. So I started buying single-family homes, finding clients that just marginally failed to qualify for bank financing, and they needed another solution. So I was looking for clients that were a year to 2 years away from being able to qualify. but they were fundamentally good credit risks. They just failed to qualify. Maybe they were a new immigrant. Maybe they had a single isolated event on their credit that caused a problem as opposed to a systemic pattern of behavior. So looking for those types of clients. And that made sense in a time when the market was going up about 4% a year and able to make good money. And then I realized, I'm writing a futures contract, basically, with a rent-to-own. I'm writing a futures contract for a future purchase of a property 3 years from now, assuming that it's going to appraise at that value, assuming that the 4% increase that we've seen every year, or whatever it was, for the last 10, 15 years is going to continue. And if it didn't appraise at that value, they weren't going to qualify for that financing. Didn't matter what we wrote on the contract. So I came to the realization that what I was doing was actually highly speculative. Even though it was working, it's one of those things that eventually would stop working. So I stopped it. Even before I ran into a problem, I said, wait a minute, I'm being stupid here. This doesn't make sense. So I stopped it. Then moved into, now we're into the depths of the downturn here in the States. And, you could buy things for far below construction cost. So, I started to see bargains all over Arizona. And that's where I went next, into multifamily, some single family, and just scaled up from there. That was basically my journey. And, I wasted some time. I got in with some bad partners in the Chicago market. One guy, eventually, had criminal charges brought against him. And, he was trying to cheat us out of money. He was not only a partner, but also our general contractor, and he would hand us invoices from his company with no paperwork to back up, his demand. And we said, well, no, it doesn't work that way. You've got to show where the money went. Like, you can't just say, well, I spent 80 grand. It doesn't work that way. So, a little bit of trial and error. And it's, like any business, associate with the best people. It doesn't matter whether you're building a hotel, a restaurant, a tech company, music business, you got to be with the best people. If you're with the wrong people, a good deal, badly managed, is no deal. So the only differentiator is the people. That's the only thing that's going to make the difference. It's never the deal.
Hello again. So I'm Dave from New Hampshire. So I've heard you talk about Chicago market, Arizona, Philadelphia, Dallas, Gulf Coast. So how do you do your macro research in order to hone in on some of these cities? Because I know you said Gulf Coast. It happened to be, a friend of a friend was head of,
Right.
But for the rest, I mean, Dallas is a far stretch from Chicago and very different weather. I mean, same time zone, but you know what I mean? Very different economic backgrounds, history. So how do you look? I mean, like you said, stuff is going on your desk every day. You have to sift through. When do you know when the city's right, and then hone in from there?
It really starts at the people level. So, I do find opportunities that look very interesting. If I don't have a team in place that can actually go execute it, I pass. I'll give you a simple example. I had an opportunity to do a flip on a luxury ski in, ski out property in Keystone Mountain, Colorado. It was a great deal. We could buy it for, 25, 30 cents on the dollar. It was a beautiful luxury property. Probably would have made a lot of money. But I had no team there, and I wasn't going to build a team in Keystone, Colorado for one project. It made no sense. I'm looking for a stream of investment. So it starts with the people. Have you got the right people? Is the market good enough in that area? But it really starts with the people. And I have folks that I want to do business with that I speak with regularly, and we haven't found the right opportunity. But at least I've got the right people, and we're working on it. So it starts with the people rather than the market area. The reason we're not in Houston is because up until now, we hadn't found the right people. We do now, but it's how many years has it taken me to find the right people in Houston? It's taken a long, long, long time.
Give it up for Victor Menasce. Thank you for being here with us. Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.